time for the Personal Finance Corner. Faye is right here. Faye, what are we discussing today?
Discussing investing in PSUs and in the brand new index that's available to us as an ETF, and this is the Goldman Sachs Central PSU Enterprise Index that's available as an ETF at a 5% discount for the next 2 days.
4% dividend yield and
yes,
loyalty bonus.
And a loyalty bonus. Does that, I mean, given how PSUs have performed over the last 1 year, does it still make sense? Is that carrot of loyalty bonus and discount enough for us? Let me bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us. This is obviously new to Indian investors. Goldman Sachs Asset Management has announced the CPSE ETF, or Central Public Sector Enterprise ETF. NFO is open only until Friday, which means that discount will only be available until Friday. After that, it's an open-ended fund. You can invest in it, but the discount won't be available. Tell us how this ETF will work, first of all.
When you invest in this ETF, in the new fund offer, you'll be getting a 5% discount on the index. This is a new index devised by National Stock Exchange, and so you will get it at a 5% discount. And if you hold it for next 1 year, you will also get, and this index is specially created to mount this ETF. This makes up of 10 companies, and they are prominent oil companies, oil refining companies, and Maharatnas and Mini Ratnas. So they are better off the lot. These companies together have a dividend yield based on the current price of about 3.5%. And so this is not a large PSU universe. This is not the generic PSU index. It is a much shorter select universe, a select set of stocks, just 10 of them, and better performing ones. And all these companies have struggled over the last 3-4 years. I don't think they have generated anything meaningful. And they look very cheap, they look very attractive, and investors will get it at a 5% discount. And if they hold it for next 1 year, they will also get a loyalty bonus in terms of units, which will be 1 for every 15 units held, which translates into something like 6.5% incremental return for being loyal to the fund if you buy it and hold it for next 1 year. The way it will happen is that if the stock prices go up, it will translate into even superior return. So this is the novelty. This is the unique thing of this ETF. This ETF has a cost of only 0.5%, 0.49%, which will make it among the cheapest of the equity funds available in this country.
Well, Dhirendra, obviously the NFO is only open until Friday, which means that this discount of 5% is only open until Friday. Does it make sense then for us to rush and book this before, this discount runs out?
This will work based on the allotment. You invest your money and you will be allotted units based on the current price less 5%. So effectively you are getting it at a discount because this ETF is created in a very unusual way. President of India is disinvesting through this ETF. Buying this NFO translates into buying stock from the funds from President directly through this ETF. So it's a little unusual, and of course the promise of the loyalty bonus in terms of unit also makes it a very unique experiment.
Well, given that we're in election year and all of these 10 stocks in this ETF are on the disinvestment program of the new government as well, what according to you will be the timeline of disinvestment? What do you see? How do you see it playing out?
I don't know what new government will do, and the kind of signals we have been getting from different constituency or what has happened on the disinvestment program in the last 20 years. We have seen all kind of things happening. We have seen the bundled lots sold. We have seen outright sell-off. We have also seen offer for sale on a continuous basis. But all of these come with this is a completely new experiment. And I think this is quite a sustainable experiment because this will not call for any significant groundwork. This will reduce the lag time. If people are interested in a bundled lot and they can buy this ETF, and given that there are a lot of sweeteners available here, this ETF right now the scale of disinvestment is only 3,000 crore, but nothing prevents the government to actually scale it up to 20,000 crore if there is an appetite through this ETF without much of a problem, because this is an ETF which will be available on tap, disinvestment available on tap, not much groundwork or preparatory work needed, and it can be well timed with the investor's appetite without a lag time.
But Dhirendra, given the performance over PSUs over the last year, and you yourself said that these 10 particular stocks have not had a very great year either, do you see merit in us investing in this ETF right now? Is just that discount and the bonus enough for us to put our money in?
Generally speaking, I do not like PSUs, simply because here the owner himself is the biggest risk. But given that the 5% discount, the 6.5% loyalty bonus, which could be even higher given your principal today, and if they go up in value, I think it looks very attractive today. But on a very long-term basis, all the problems of a government company prevail.
All right, so if you're making a short-term investment for the next 1 year or so and you're willing to take the risk, then it does make sense to apply, but do so before Friday so you can take advantage of that 5% discount. We have a couple of questions. Bharat Kumar has written in. He writes in from Bareilly. He says he wants to invest 5,000 rupees every month over the next 15 to 20 years for his newborn baby. Well, congratulations on the baby. He wants to know where he should invest his money. He's obviously a first-time investor, Dhirendra. What would you like him to do?
Somebody who is a first-time investor, I normally suggest that get started with a balanced fund, and I think it will be the same here. What we have seen in the last 4 or 5 years, investors getting started with, of course, equity will be a superior bet, but I would still suggest to go with a balanced fund, simply because the benefit of rebalancing, the tax efficiency of a balanced fund, and you will derive most of the benefit that can be derived from an equity fund through a balanced fund, with very moderate volatility or a relatively less volatility than an all equity fund. And if I have to suggest some, I would say ICICI Prudential Balanced Advantage or the Reliance Balance.
All right, let's take another question. Emerson has written in. He wants to know if it's a good idea to invest a lump sum amount to start with into mutual funds and then shift to an SIP mode after that. He hasn't told us how much he wants to invest, Dhirendra, but we don't normally recommend that people invest lump sum amounts. What's your advice for him?
I never suggest a lump sum in equity, and lump sum, it depends. If the lump sum is a very small amount, so effectively you are getting started on an odd date, it doesn't matter. But if you are planning to invest a large amount in relation to, assuming that you plan to do a SIP of 10,000 rupee, and if you are investing 2 lakh rupees upfront, that is undesirable. I would suggest that even spread your lump sum amount over some period of time if you are, if you are a first-time investor, simply because the moment you invest and you see the turbulence, you are so much more watchful, and that creates a great deal of anxiety, and that has the potential to derail your investment plan.
All right, Dhirendra, many thanks for answering our questions on the show this afternoon. If you have questions, write to us. Email ID is on your screen right now.